Hello everyone, this is John with the Wall Street Voice, and today on Options Made Simple, we're going to be talking about option value. Our main focus today is going to be on intrinsic value, extrinsic value, and implied volatility. At the end of the video, we'll talk about the dreaded IV crush and how it affects the value of your options. But before we start, I want to make clear what a derivative is, since all option contracts are derivatives. An option contract in itself doesn't have any value in the sense that it's just an agreement to buy or sell 100 shares of stock on a set date. Where the value comes from is the underlying that the contract follows. For stock options, their underlying is usually a stock or an index, and for future contracts, which are also a derivative, their underlying is usually a commodity or an index. The two values you need to be aware of with option contracts are intrinsic value and extrinsic value. We'll start with intrinsic value. Intrinsic value is defined as the measure of an asset's worth. Make a note that only stock options that are in the money, meaning the share price has surpassed the strike price, can have intrinsic value. The reason why they have intrinsic value is because if you were to choose your right to exercise that option that you bought, you would get real value in return. For example, suppose you had a call contract with a strike price of $35 and the current share price was trading for $40 per share. In this case, your option contract would have intrinsic value because you could exercise your right to buy 100 shares at $35 per share, and if you sold them for the current price of $40 per share, you would make $500. Therefore, your option contract would have $500 of intrinsic value. To calculate the intrinsic value of a call option, you would subtract the strike price from the share price and multiply that times 100. And for a put option, you would do the opposite, where you subtract the share price from the strike price and multiply that times 100. One thing to keep in mind is that intrinsic value is linear and easy to calculate, but extrinsic value is not. So what is extrinsic value and why is it so hard to calculate? Well, options that are out of the money, meaning the share price has not surpassed the strike price, are composed of only extrinsic value. Just think about it. An option that hasn't surpassed its strike price is essentially worthless. If you were to exercise that option, you would take a loss on the trade. Yet, people are still buying that option and they're assigning value to it. So, whatever people are willing to pay for that option that is out of the money, that is the extrinsic value of the option. To add another layer to extrinsic value, unlike intrinsic value, which is linear, extrinsic value is variable and will fluctuate throughout the life of your option. If you have an option contract that is out the money and the underlying share price continues to fluctuate but stays out the money, then it's really hard to say what the extrinsic value is going to be, even if it goes back to the previous price that it was trading at. Because, as I said earlier, the extrinsic value is only composed of what people think that option is worth. So if you're trading at, let's say, $32 and it goes down to $28, you're going to lose a bunch of extrinsic value because people now see that option as less desirable because it's going to be harder for it to get back to its strike price. Even if it were to go back up to $32, you probably would not gain back all of the extrinsic value that you lost. It's not just out the money options that have extrinsic value, but in the money options hold extrinsic value as well. So we'll go back to our previous example of holding a call option with a strike price of $35 when the underlying was trading for $40 per share. If you remember, we calculated that this call option had $500 in intrinsic value. So if that call option was trading on the market for $700, the extra $200 would be the extrinsic value of that option. Time plays a significant role in the extrinsic value of an option. This is because the longer an option stays out the money, the less likely it is to expire in the money and have intrinsic value. Look at it this way. An option that has 60 days until expiration still has a lot of time to surpass its strike price and expire in the money, so traders are willing to pay a big premium for that option. But what happens when you get down to 2 weeks or 1 week and that option is still out the money? It is now less likely that option will expire in the money, and therefore traders are less willing to pay a big premium for this option because it's probably going to expire worthless. Now keep in mind that time only affects the extrinsic value of an option. It has no effect on the intrinsic value. The only factors that affect the intrinsic value of an option are the strike price and the share price. Now let's add the last layer to this, implied volatility. Stocks that are expected to have big movements in price and large fluctuations have high amounts of implied volatility. Traders are usually willing to pay a higher premium for stocks that are more volatile because there's more potential there to make them larger amounts of money, and this will directly add on to the extrinsic value of the stock. There's a few catalysts that can directly affect the implied volatility of a stock. The biggest and most well-known one are earnings reports, because usually after an earnings report, a stock will have a big move in either direction. But it's not just earnings reports. Market corrections, market crashes, unexpected news, whether it's good or bad, can all increase the implied volatility for a stock. So the beauty of implied volatility is that it can artificially inflate the extrinsic value of your stock option even as time passes. If time is passing, but the implied volatility of the stock is going up, then rather than losing value, your extrinsic value might stay the same or even go up. But the opposite is also true, and that's what's known as IV crush. And this is when your option loses a lot of its implied volatility, and it has a direct effect on the extrinsic value of the stock. And then so suddenly you wake up overnight and your stock option is worth 50% less than it was yesterday, even though the underlying is still trading around the same price. The best way that I can honestly explain this to you is in terms of Beanie Babies. I don't know if you guys were around for this, but back in the 90s when they had the Beanie Baby craze, everyone lost their shit for Beanie Babies. Kind of like how everyone loses their shit for GameStop options. And just due to supply and demand, the value of the Beanie Babies went up through the roof. But then what happened? Eventually, people lost interest, and the value, the made-up value for the Beanie Babies, or you can even call it the extrinsic value of the Beanie Babies, it plummeted, and suddenly they were basically worth nothing again, or they were worth what they were originally sold for. And this is exactly what happens after earnings reports, or when a stock that was volatile starts to settle out and is no longer volatile, although implied volatility goes away, and this directly crushes the extrinsic value of the stock. Because keep in mind that extrinsic value is just made up value, and so it can go very high for no reason at all, just from people being excited. But as soon as people lose that excitement, it can plummet, and there's nothing to stop it from suddenly losing half of its value. And that's what IV crush is, and it's something you need to be very aware of when you're trading stock options that have high amounts of implied volatility.